What is going on, everybody? Today we are going to be talking about a stock with low risk and high return. And that stock that we're going to be talking today is Airbnb, ticker symbol ABNB. Today we're going to focus on, first of all, understanding their business model and how they make money. Second of all, we're going to look at their growth trajectory. Then we're going to look at the overall industry, the tourism industry, and see how that industry is going. And then we're going to look at Donald J. Trump's presidency and see how that's going to affect the stock. And lastly, we're going to go on my iPad and I'm going to show you guys an in-depth, sort of clear overview on why the stock is undervalued, right? All right, let's head right into it. Now, first of all, what is Airbnb doing? I'm going to say this for the couple of people who don't know. So Airbnb, I'm going to read it off the website. Airbnb is an online marketplace that connects people looking to rent out their place with people seeking to rent a place, right? Everybody knows what Airbnb is. But how do they make money? That's the question. Right, Airbnb mainly makes money by service fees when people are booking. It's divided into two sectors. One is the user, the person who wants to book. He pays around 10%, and then on the other side we've got the host, which pays also around 15%, which means that overall Airbnb is getting 25%, a huge chunk of money off a booking. It serves as the middleman between a user and a host. It's a software company, which means that they're gonna obviously make more money than the average company, right? So that's all very nice and good, right? But how are they growing? Airbnb grew 18% in Q3 2023, year on year, then 17% in Q4 2023, and then another 18% in Q1 2024. This shows that the revenue growth is simply not slowing down. And when I look as a normal human being as our biggest competitor, which is Booking, which grew for 20 years around 20% every year, which is just showing to me that Airbnb, newly founded stock, IPO'd about 4 years ago, has 20 years now of free playing field to grow 20% every single year. Isn't that nice? Now let's look at the overall industry. I'm going to read this report here. The IRE reports show that travel and tourism GDP globally is forecasted to grow at an average rate of 6% annually between 2022 and 2023, out-averaging the 2.9 growth rate of the global economy, which shows to me that even if they're not growing, they're not expanding, nothing, they should still be able to grow 6% year on year. But that's not what's happening. Why? Because they're investing their money into expanding the business. Newly founded tech company. That's just nice. Now, one leading major catalyst on which I'm betting for, and I can see swing traders and short-term options trader sort of speculating on, is Donald J. Trump's presidency, right? If he comes to power, it is said that Donald Trump, with his tax cuts and his other reforms, that he will stimulate the economy, giving into spending, which means that the average person will have more money than before to go ahead and travel, right? So that's even better, I see. Now all of this sounds extremely well and stuff, right? But the question is, are all of these positive outlooks and positive near-term growth, is it already built into the stock today? Well, that's the question. We're going to hop on my iPad right now and we're going to go into an overview sort of stock valuation to see if it's overvalued or undervalued. Alright, so now we are on my iPad and now we're going to do an Airbnb stock valuation. Let's start. First of all, I want to address one huge mistake that people have done, is that once you go on Google Finance and whatever stock brokerage you're using, you will see that they have a PE ratio of 19.81. That is a hugely good PE ratio, and that's actually very wrong. Because if you go on the annual revenue, right, 2023, it says that they had a huge spike in net income, led by a net profit margin of 48%. Which I don't know why this has happened. Their net profit margin is usually not 48.3%. That is very extraordinary, and it's never happened with the NASDAQ company. It's probably because of like an acquisition or something like that. Anyway, so what we're going to do, right, is we're going to project their earnings. So 2023, 9.9 billion. We are going to go with a revenue growth of 10%. Why are we going with 10%? Because, well, I think they're going to grow 20%, but I think that's sometimes when you look at it, not really realistical because the average tourism sector is growing 6%. So I think they're still going to grow more than the average tourism sector, but let's go with 10%, right? So in 2024, I've actually made this calculation before here. They are going to be at 10.89 billion. In 2025, which is the second year that we're projecting, they are going to be at 12 billion. And in 2026, they are actually going to be at 13.2 billion in revenue. Now let's calculate the net profit margin in 3 years' time. So first of all, 13.2 billion, we're going to multiply that. They make around 12% profit margin. So we're going to multiply it by that. And I've actually calculated that also, which means that in 2026, they're going to have 1.5 billion in profit in 2026. Now, we are going to calculate their PE ratio in 3 years, discounted back to today. Now, you're going to see what I mean by that. So, what we're going to do is we're going to divide, we're going to divide that 1.5 profit divided by the current market cap. So 1.5 billion in profit divided by the current market cap, which is 93 billion. And then we are going to arrive at 60 PE ratio, which is obviously not 20 like we saw on Google. So what does that mean? That means that that discounted back to today with the revenue of in 3 years' time, they're going to be at 60 PE ratio. So that means in 3 years, with today's market cap, they're at 60 PE ratio. Now I think 60 PE ratio is exactly a good PE ratio that this stock should have. They're a good growing company, a tech company. I don't think they should have more than 60 PE ratio, which leads me to make the assumption that in 3 years' time, they're going to be around flat. They're not going to grow, the stock price is not going to grow more, and it's not going to dip more. So I think it's going to stay flat. It's currently not a good buy, but once it actually goes ahead and takes a huge dip of 30-40%, I would make sure to go ahead and buy the stock, especially if their next year's revenue growth is going to be as well another 18%. So overall, right now, not a buy, but it's a hold and an eventual buy.